So look, at a high level, as Rick said, these sort of illustrate the macro variables that are most meaningful to the economy. And the point I would make in looking at this isn't that there's anything particularly different than what there was 3 months ago. In fact, the point I would make is that there isn't anything particularly different than there was a few months ago. Just because the calendar changes doesn't mean that the world resets, doesn't mean that the economy resets. And particularly in the case of the US, it hasn't. The balance around these variables is largely the same as it has been. The Fed is more worried, as I think all of us are, about the unemployment rate going up than it is about the unemployment rate going down. They're more worried that inflation will stay too high for longer than they are that it will undershoot, as I think we all are. And they're more worried that growth might slow than that it might accelerate. That's where we've been for quarters and quarters and quarters, even years, right? And as Rick illustrated, despite that, the market has continued to go up from a stock market perspective. Nelson will talk about that. But that underpinning hasn't changed, right? This is the same that things have looked for the last few quarters.
We're going to play some word association. So let's start with growth.
Solid. So I am torn in the description of growth because I don't think we have a great way to measure it. Many of you have heard me say this before, and I'll say it again here. The number that we look at when we talk about growth most often is GDP, gross domestic product. It is a truly, truly heroically silly number. Right? The idea that you can capture everything that goes on in the economy in any one number is kind of preposterous in the first place. The way that GDP is constructed has all of these sorts of moving parts in it that can make it very confusing to interpret. Just to give one example, and believe me, I could do this for hours, right? If a business faces weak demand so that they can't sell their inventory, and indeed their inventory goes up, that increases GDP, even though it is sending a weak signal about actual growth, right? Most of the time over the past few years, if you sort of take a step back, wait a few quarters, all of those sorts of back and forth issues around inventories and trade flows and so on come out in the wash, and over medium and longer term time horizons, GDP probably gives you a reasonable read on what's going on in growth. But I'm not sure that's true right now. And I think if you flip to the next slide, you'll get a feel for why that is. It's really important when we try to formulate a forward-looking outlook not to get bound up in whether the headline GDP number is 2% or 1% or whatever, but what the actual driver of activity is in the economy, what the actual driver of demand is in the economy. Because at the end of the day, that's what policymakers are looking at. Policymakers, from the central bank perspective in particular, can influence demand in the economy. So that's what we're looking at. And if you look at what drove demand over the course of last year, look on the left side. Business spending, excluding tech investment, was basically flat. In the middle, what you see is a nonlinear increase in tech spend. Now, we don't get a specific category breakdown within GDP that allows us to say, aha, this is AI related. I trust at some point in the future, AI will create that subindex for us, but it has not yet. But this is tech investment, which I think, given everything else we see in the economy, is almost certainly related to AI. So from a business investment perspective, from the demand that businesses have for investment, what we are seeing is that is almost entirely, as far as we can tell, related to tech and artificial intelligence. It's not broad-based. And on the consumer side, on the right chart, you see something that's similar. This is the percentage of consumption that's driven by the top 10% of earners in the economy. This is at a record high. Roughly 50% of total consumption is driven by 10% of the population. So just as we would characterize the expansion in business investment as being narrow, we would say the same thing about consumer spending. In aggregate, it looks okay, but the base is increasingly narrowing. And when that happens, the question is, how sustainable is it, right? And there are mixed signals on this. On the downside, business confidence, which includes lots of companies that are not at the vanguard of the AI revolution, is persistently low. Consumer confidence also is low. And the way that this is being characterized in, I hate to call it the popular media because I think it's really the financial media, which is not and should not be popular in any sense, is the idea of a K-shaped economy. And we've drawn the K over on the right there. The turquoise line is the S&P 500. It's equity performance. You could just as easily put corporate profits in there, given the correlation between the two. But the S&P continues to go up, up, and up. And when you think it's done doing that, it goes up more. Meantime, consumer confidence has fallen. And so when we think about how this looks, what it means from an economic perspective, what it means from a household perspective is if you are in the top part of that K, if you are a part of the investor class, if you have money in markets, you're probably doing really well. The S&P has not just done well, it has outperformed inflation by multiples going back into the mid-90s, and that has accelerated. By contrast, if you're on the other side of the K, if your primary source of wealth or of income is from your labor, you're not doing as well. You're probably treading water at best. Yes, wages are beating inflation but not by a lot, and not by nearly as much as the S&P is. So again, this idea is that the expansion is very narrowly based at this point, right? So how has this held together, and how long can it hold together? I think the answer is in the labor market, right? The bottom part of that K, the reason I don't love the K graphic is because it implies that there is a collapse in household well-being. And I think that's an exaggeration, right? Wages are beating inflation, right? I think it's better to think of most households in the bottom part of that K as treading water rather than collapsing. How long can they tread for? They can tread as long as the labor market holds up, right? As long as people are employed. For most people in the US, their primary means of consumption is to spend their income. If you're employed, you still have income. We are seeing signs of weakening in the labor market. On the left side, the unemployment rate has ticked up consistently over the last several months, but only modestly. We'll get another print of this tomorrow morning in the US. And you see both underemployment and the duration of employment also ticking up. Now, if we expanded the time horizon on there, what you would still see is that they are low by historical standards. This is a trend that is moving in the wrong direction, but it is not at a level that is alarming. And that suggests to us that things still look like it's sustainable for the time being, that the economy is not about to roll over, that households are not about to pull back into deep distress. Part of that is because the labor market is largely frozen, but it's frozen in sort of an unusual equilibrium, right? Well, what we've seen is the rate of hiring slow, and you can see that in all of the various charts here, but not pivot yet into layoffs, right? We have not seen the sort of layoffs in the corporate sector that signal a recessionary dynamic in the economy. And anecdotally, you don't really hear that either. We have ways of measuring the labor market at a higher frequency, and they in aggregate are not signaling alarm at this stage. It is the key variable, I think, to monitor this year, because if businesses pivot away from just not hiring and into layoffs, whether because demand slows, whether because AI encourages them to hire computers rather than people, however you want to think about it, then that would be more alarming. But for now, it looks to us most likely that things continue to hold together. And again, you can see, again, the trajectory on all of these is not particularly encouraging, but the level is still generally okay.
All right. And so in order, now we make our way to inflation.
Yep.
We're going through this, I keep thinking back to the last 5 years and which one has ruled the roost. Labor is kind of ruling the roost right now, but we have a lot to say about inflation too.
Yeah, but we have less to say than we have in the past few years, and that's great. Right? It is a much harder world when inflation is what the central bank is worried about, because it really ties their hands. It constrains their ability to respond. If we're wrong, for example, and the labor market does weaken more, the policy response to that should be rate cuts, fairly aggressive rate cuts, in order to stabilize demand, to incentivize businesses to hire, and to get people back to work. If inflation is a problem, though, they can't do that. And the way that the Fed interprets inflation right now, and the way that we do as well, is that there's a little bit of wood to chop yet, but it is on the right path. It's moving in the right direction. Inflation is coming down. Were it not for tariffs, I think the progress on this front would be much clearer. Tariffs have pushed prices up of tradable goods in particular. That process has more to run. We do not expect inflation to get all the way back to the Fed's target this year, largely because the lagged impact of tariff-imposed price increases is going to keep it elevated. But as long as it is moving in the right direction, as long as inflation expectations are stable, we don't think it is a constraint on Fed action. Our forecast is for the Fed to cut rates 4 times this year, which is more than the market is currently pricing. If things get worse than we anticipate, we think they'll cut more than that. And it's encouraging news from an economic perspective and a market perspective, both that they see the world in a similar light to the way that we see it, and that they have the capacity to do that. We're sitting with rates still well north of 3. So they have a lot of room to move if they need to.
For me, my little 2 cents I want to throw in here is just how extraordinary the years post-COVID have been. The Fed couldn't buy 2% inflation I've said this before on the call, for a decade. The average 1.8%.
Because we're too low.
I mean, they couldn't get there. They couldn't get you home, right? And then COVID hits, and I refer to this as the era of exogenous inflation shocks. If you had a super villain of inflation shocks from the last century, and you had them all show up movie style, one after the other, in the form of a global pandemic, a European land grab, lock-in, lock-out effects on mortgages, the massive second round of stimulus, which has been research on the inflationary impacts there, all the way down through the rogues gallery, and they just kept triggering one after the other, making their way through goods and food and energy and services and specifically shelter and all of that stuff. And so it slowly, each one was making its way back down towards trend. And then we have tariffs, which become the last link in a series of exogenous inflation shocks. And so now you can see the quotes floating around the outside.
You know what the most remarkable thing about all of that is, though, and the most important one, is that throughout that period, all of the ways in which we would measure inflation expectations, both of consumers, of businesses, of market expectations, have been stable. The market continues to believe, and households continue to believe, and businesses continue to believe that the Fed will do what is necessary to keep inflation under control in the future, to prevent what has happened over the past couple of years from becoming permanent or durable. And that's critically important because inflation expectations are self-reinforcing, right? If people expect prices to go up, they buy more today, that pushes demand up, that pushes prices up. So to see inflation expectations stay stable through this whole period is really a remarkable thing. It's a measure of just how strong the Fed's credibility is. And, you know, we can talk about the risks around that with Fed independence and the possibility that the Supreme Court will eliminate it, which would be a potentially paradigm-shifting event. But in the here and now, the Fed's credibility is enormous, and we're all benefiting from it.
And one of the questions we got is, you know, for all the tariffs, we haven't seen as much of a dramatic effect, and I think there's lots of things to talk about, but one of them is right here.
Yeah, look, we are absolutely seeing inflation in tariff-related products, right? So things that you have to pay a tariff on coming across the border have gone up, but we're seeing offsets in other places. So house prices are down a little bit, and the lagged impact of declining house prices has pulled shelter inflation down. Shelter is the largest component in the inflation basket. We think there's a little bit more room to run on that too, and in past quarterly presentations, we've shown a graph of the relationship between shelter inflation and house prices, right? You still see that relationship holding. And so there is more downside there. The other thing is that, you know, to put it in shorthand terms, the lawyers have gotten a hold of the tariffs. And that means there are exemptions and exceptions, and that whatever is announced as the rate is not the rate that most people are paying. The effective tariff rate has gone up by less, certainly than the Liberation Day announcements, but even by less than what the trade agreements that were reached with various countries would have you believe. It's still a very significant increase relative to the past, but you know it's getting chipped away, and that has limited the impact on inflation.
Yeah, and we should just also note, right, before we leave tariffs, that we're still negotiating with Canada, with Mexico.
We're still negotiating with Canada, with Mexico. There's still a lot of uncertainty there. There's a case before the Supreme Court about whether and I have to say this carefully to be accurate, the case is not about whether tariffs are themselves legal. It is about whether the legal justification that the administration used for these specific tariffs is valid for those specific tariffs, or if they have to go back and find a different justification, right? So our view, we don't have a view on the Supreme Court decision, but our view is that even if the Supreme Court invalidates the tariffs as they were imposed, the administration does have other ways to impose them. And would go back and do that. It doesn't seem very likely that the administration would simply say, well, the Supreme Court said we can't do it, so we're not going to do tariffs. They will find other ways to impose them.
There's this, just the last one, and then we'll wrap up with some of the summaries, what the Fed thinks, what you think, then we'll move into the asset groups. This idea of a one and done on price impacts of tariffs, something that Powell has spoken about as well. There's the left-hand chart kind of shows that was the first administration experience, and there's a little bit of expectation as well. And the right was the shelter you just mentioned.
Yeah, that's the right one is where we were talking about the impact of house prices and how it's pulling shelter inflation down. Look, the one and done on tariffs, I think we were probably a little sloppy in the way we described that, in the sense that when you say one and done, it seems like it's an instant impact. In large part because of the way that the administration has imposed tariffs, which is to say sort of stop and start, stop and go, fits and starts, on this month, off next, on again, but with a 2-month forward time horizon. The impact has been more spread out across time. It hasn't all come into effect. the announcement was on April 2nd. It's not the case that all the tariffs went into effect on April 3rd and stayed there. So it has taken longer to filter in. The net result is that you haven't gotten as high a spike in inflation, but you've gotten a longer time horizon where it has been impactful. That is probably a better case for the economy rather than seeing a sudden sharp increase in prices. As long as inflation expectations stay stable, allowing for a more gradual adjustment has been helpful.
So first, how does the Fed put all this together?
So the Fed puts it together and says growth is okay. We don't really know, and I know we'll talk about this going forward, we don't really know what the impact of AI is going to be. And so we don't want to make any heroic forecasts around that. We think the labor market is weakening and labor demand has gone down a little bit more than labor supply. The unemployment rate is going up and we don't want it to go up any more from here. Inflation is largely behaving outside of the tariff-related industries and expectations are stable, and that gives us the room to cut rates. And their own dot plot suggests that they see cutting rates a couple of times this year. We think they might go a little bit more than that. I wouldn't make too much about a 12-month forward difference of 50 basis points in terms of where rate cuts are. We'll see how it plays out over the course of the year. If the labor market stabilizes and the unemployment rate doesn't go up, then they probably won't cut as much as we expect. If it goes up a few more tenths, then they'll probably have to cut a little bit more than they expect. Again, all this assumes that the Fed is independent and making decisions based on its economic analysis rather than based on what it's being told by the political side. And as long as that's the case, from a market perspective, I don't really think it matters very much if the Fed cuts twice, 3 times, 4 times over the course of a year. What matters is that they are on a trajectory toward lower rates. And, one of the questions that came in, is there a Fed put? I have never liked the term, but look, there is a Fed put here in that if things get worse, they could cut more. And so as long as we're moving lower, as long as we're not talking about inflation running away and rate hikes, I think that policy is likely to be supportive of markets this year.
And speaking of they could cut more, and something you said a moment ago, I just asked about what the Fed thought. Why don't you talk about what you think?
Yeah, so these are our forecasts. And, look, you can see that we're forecasting at 4 cuts this year rather than the 2 that the market is, 2.5 the market is currently pricing. Market pricing moves around a lot. We try to be more stable with our forecasts. We don't want to respond to every bit of noise. Our view is that the neutral policy rate for the Fed is around 3, and at the very least, we expect them to cut down to 3. I think it might make sense for them to go a little bit lower than that if the labor market continues to look wobbly. And I think they'll have the bandwidth to do that because inflation is going to come down. You can see our inflation forecast is 2.5% for this year. That's a little bit lower than where the market consensus is. And you'll notice that what I haven't talked about that in that discussion is growth. Because again, GDP, I don't think is particularly informative about what's really going on in the economy right now.